Thank you for watching Resource Talks. It is the end. Well, actually, no, I need to stop saying that. It's not the end of the week because we're no longer uploading these on the weekends, and at least for now. So it's probably the beginning of the new week because I try to upload these on Mondays now, and we're actually recording this on Wednesday. It is pre-market open, so we're not doing a market performance overview because Luke is going to a conference, three conferences actually. I think I'm not. I feel like I did a couple of too many really last year, and it quickly becomes more of the same for me. Although I still kind of enjoy the process most of the time, and I'm sure I'll get dragged into at least a few later on in the year. For now, I'll remain safely tucked away in the dungeon here, dreaming of the beautiful Belgian skies with their infinite shades of gray. But before I start getting poetic,
We're going to talk about nothing before I've warned everyone listening that although none of the companies mentioned or featured in this publication have paid us to talk about them in this episode, this channel is a business. This channel earns its money by charging junior mining companies for interview production, which means there is a high probability that some or even all of the companies that we will cover in here have either paid us for such interviews in the past or might pay us in the future to conduct such an interview. In addition, all of us are junior mining speculators, both Luke and I, which means we may own shares of companies mentioned in this publication, or we may have owned shares of them in the past, or we may own shares of them in the future. All of this is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be at least some type of bias in what we say in here. This entertainment program is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business. That's not something in most of the cases that you can call investing. That's why I'm emphasizing on speculators. And losing money is the norm and should be the expectation, as this is a very complex sector and the performance of individual companies typically depends on many different factors, including geopolitics, macroeconomics, commodity prices, and so on, but also company specific factors like the geology and the management and the jurisdiction and the laws and this and that, many other factors, most of which are not really foreseeable. Unfortunately, and believe me, I have tried, I don't possess any superior knowledge, and my crystal ball seems to be broken because I don't know anything about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sort for that matter, as this is going to be a conversation that is general and impersonal in nature between a couple of individuals, none of whom are licensed financial advisors and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So before continuing on, please talk to a professional investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.ca, where you'll find the company's official filings. And if you don't do that, you're highly likely to lose your money.
that said, today we're talking about two topics: portfolio building a la Luc and stock picking contest that's going on right now, I believe, or it's done. I know you'll tell me more about that, but the first being my idea, which means that's the part you want to skip. The second one was Luke's idea, but the comments we get on these weekly podcasts are actually rather good, in my opinion. It's not the typical, trawling and pumping of stocks, and although there's some of that too, there's really no escaping that. But I want to do this more often, actually. Maybe we'll make it a weekly segment where we can read some of the comments from the prior week and Luke and I can talk about them. So if you have anything funny to say about my accent or my hair color or Luke's headset or his chair, I think someone commented on his chair. Now might be the time. But so to kick it off, last week there was a comment. There was a couple of comments really, but there was a comment from one Mr. Stef van Loon, which actually that's a Dutch name as far as I can recognize it. So it basically means Stef of salary in contemporary Dutch, although I think this is probably, it refers to medieval loan, which basically at the time I looked this up, it means a piece of land, kind of like a wet, soft land, often covered with mud, kind of like the majority of projects listed on the Venture Exchange. But this is sadly not the History Channel. And Mr. Steph, he commented, and I quote, full disclosure, full FOLL You see what I did there? I laughed. You should too. It's funny. But I've been in the market for slightly more than 25 months. Dot, dot, dot. I'm all in on junior mining stocks. Dot, dot, dot. My CAGR is hovering around the 35% mark. Am I doing okay, or should I be doing better given the high risk, high reward nature of the sector? I own 21 companies at the moment, 6 winners and 15 losers. Dot, dot, dot. My portfolio is very far from being even weighted. Dot, dot, dot. Any feedback is more than welcome. Dot, dot, dot. I like the dot, dot, dot in his comment, by the way. It is kind of like junior mining. He starts off with big questions, bit of excitement, bit of hope, followed by very long pauses, silent pauses of waiting and hoping and questioning life until the draw results come back, that is, at which point you're just left with more hoping and probably bigger question marks. But I've been talking for long enough as it is. I plan on shutting up shortly here. And I think we should kind of take this step by step, pick the comment apart and try to analyze what he's saying with of course, the caveat being we're here to just shoot the brown stuff. And none of us are licensed to anything really. And this cannot be interpreted as advice. Go back and listen to the disclaimer at the beginning. Don't take us too seriously. None of us are experts. You might want us to, but we're not. But so yeah, Luke, let's start off with the first statement, I suppose, that Mr. Steph here is making. He's all in on junior mining stocks, which is one way to put his money where his rocks are. And hopefully it's substantially big rocks that we're talking about here in his case. But jokes aside, this seems very irresponsible to me. For the vast majority of normal people out there, this is just reckless behavior to be 100% into, non-revenue generating venture capital sector, which is why it kind of makes sense that you're 100% into junior mining, Luke. So this fits right within your wheelhouse. So tell us, why do you hate yourself?
Yeah, it's probably the smartest thing you can do in your life to be in junior mining stocks completely and depend on it. But in a way, we all do it. At least we all, meaning people we often talk to. We all have this betting, desire, and as long as you're not really depending on it, you either have a salary or you have other savings. It's of course extremely important to really understand that we are in a very risky, illiquid, volatile market. And he has been doing it for 25 months. I'm not sure if that's junior mining only or it has of 25 months of complete investment experience. Either way, it's even bigger risk. I guess I still see myself make mistakes every month almost, but I have the impression they get fewer. And if I look back myself in 2013 or 14, being 24, 25 months in this market, I was making probably a mistake every day. So I think it's important to realize you're still a risk to yourself. You're always a risk to yourself because you get stories, opportunities every day, and you get tempted to buy these things. But looking at this return, pretty amazing, 35% CAGR, which suggests he's up 85% in this period. I'm probably not up 85% in this period, so well done. I'm sorry
for interrupting, but maybe we can take it. That's actually my second point on here, because I think that's a whole another separate point in and of itself. I think 25 months is maybe, I find it too short of a period to even start measuring CAGR. We can also talk about the concept of CAGR within junior mining. Like, is that something you want to put yourself up against in the first place? But I want to go back to the all-in part, which is kind of the most, I suppose, most shocking one to me. And I struggle with many biases. Like I've went from overly bullish and overly confident at the beginning of my career, if you can call it that, 3, maybe 4 years ago, to, well, longer than that actually at this point, but junior mining specifically 3 or 4 years ago, to basically thinking that everything is a zero. And so I might have a more negative kind of black pill view on it all, even though I looked out last year in 2024, I did have a good year for the portfolio, mostly based on luck and talking to people like you and going into the right stuff, but none of it based on my own skill. So I still don't believe I can do it. And that's also because, as far as I can see, most stocks will not provide meaningful returns for most people. Definitely not enough to compensate for the risk, right? Especially the heavily advertised ones. and it seems to me this might be something fitting to the second topic with the stock picking context that you want to cover later today, Luke. But it seems to me that it is the heavily advertised stocks that people tend to stick to and create kind of a cult following around. So basically, the more social proof I see around a company, the less interested I get, because that has it has the potential to distort my ability to judge the opportunity properly. So it creates a very strong availability bias because you see it so often. That, of course, quickly turns into confirmation bias once you go and talk to people who agree with you, and herd mentality, and then eventually it's just basically a cult, as I said, which I've already fallen into. Luckily for me, early on in the career, quickly got out of it, again through talking to people like yourself. So I'm very lucky to have met you and a bunch of other people helping get out of it. But also, when companies advertise through like generalist means, like they pay to get on Fox News or whatever news, or I don't quite follow any of these, but conspiracy YouTube channels, or like a YouTube channel that talks about the future of something, and then it all of a sudden turns into an advertisement for or Copper Explorer Co. and stuff like that. That's typically a red flag, which we've discussed in the past. But so why I'm saying all this is because it seems that this is how people find out about stocks in the first place, especially when you see like multiple Twitter channels mentioning it. You kind of start building up this availability bias, turns into confirmation bias, as I said. And oftentimes, of course, helpful to understand, not oftentimes, always in finance and investing is that's one of my main rules, is you need to understand your counterparty's incentive. Why are they telling me about this? Why are they talking about this? Why are all of a sudden all these channels talking about it? But anyways, those specific companies typically have badly skewed ratios. In my experience, is what I wrote down. So with the two most important, when I say ratios, what I mean by that is that this is something I go through I try to go through it in all my interviews with companies, being the exploration to administration ratio. It's just take the whole exploration evaluation cost divided by the administration spend, meaning that's your G&A, office, marketing, everything together. And I want it to be at least a 4-to-1 ratio, meaning at least 80% goes to exploration evaluation and 20% to administration. I don't stop there, though, because some companies hide a lot of consulting costs within the exploration and evaluation expense. So I go to that note that breaks those down, and I take out specifically the drilling cost and compare it to specifically the marketing cost. Doesn't work in all stages of the Lassonde curve, but we're talking about exploration here for now. So I separated from the administration part of that ratio. And so I do drilling to marketing specifically, and it tells me if this is a marketing company or an exploration company. But even then, I mean, I went off on a bit of a tangent here and going through some of the notes that I made. But even then, that's not a recipe for success by any means. Even then, the vast majority of companies won't make it because of the risky nature of the business. Just the general, there's a very high number of moving particles that influence the future of the stock price. Timing is something we've talked about, and timing depends on your geopolitics, to macroeconomics, to microeconomics, and the specific commodity prices, to niche country regulations and management relationships and capital raising capabilities and marketing, and the list of things that could go wrong and do go wrong and will zero your stock eventually is kind of endless. So being 100% in junior mining, unless this is your life, like you do nothing, well, I mean, even still, I don't see it. And don't get me wrong, it doesn't necessarily mean that everybody's going to fail, and there will always be these examples of people who had 10 grand, made it to 1 million type of pitches. But this just kind of amplifies the potential, if you will, for large losses if you're 100% in junior mining. You don't, especially if you like the volatility. We're not even talking about that yet, especially if you don't enjoy that. But enough of that. I feel like you want to add something because you were taking some notes, and this was kind of a long rant. But what are you making of all this?
Well, I'm happy to make notes because I'm counting 9 topics that you just talked about. And I was thinking, how are you going to get this to a question? But you just say, please comment.
Basically, yeah. It was a rant. I don't have a question. I don't even know where, like, it was just notes.
Now, the first thing, the all-in part, being all in this market, it really depends on all in, meaning everything you have, or meaning everything you have available to speculate with, or your complete investment portfolio. So all in is a bit of a term. I don't know what it is, but means be careful. And I think your story also summarized, like, we have many zeros in this industry, and that's, I think, a good approach. I always think every company I see, I consider it a well, like we discussed before. It's a bet. It is a story. It is not much more than a couple of claims, a company name with a logo, an entity with an auditor and a financial person, and some people thinking about what they want to do with the money they raised, often $500,000 or $1 million, and that's going away very fast. And if you think about it that way, you also talked about advertisement, marketing, storytelling, metal prices, all these things play a role. And the frustrating part is that often companies that do a lot of that stuff but don't have much, they react very well to metal prices. For example, antimony did well last year. The company with the biggest American flag and American military picture on the website, a really amazing website, did really, really well. And that's the one I have my doubts if they are serious about the project or if they're just trying to promote something. That company, well, the project they have seems to be okay-ish, but it could also be just a way to get a pump going and perhaps it works out for a year or two and then it goes back to zero again. The company with, in my opinion, probably a good antimony project, is a diversified company and that gets no credit for antimony prices, which is again a bit frustrating for the investor. In the end, there's only a few companies I think that will really add value and keep that value also in the market. So they go up to a certain market value and a certain share price, and they maintain that level. Of course, they will still be volatile, but they go to that level and they stay there. Founders surprised me, like we discussed recently. It found this new level of 400 or 500 million, and so far it's staying there and it's growing. Amazing. Most companies go back to zero very quickly or to $10 million. So I think agreeing with most of you said, is be careful with everything that you hear from the company itself, from the marketing campaigns, from social media, and consider things a bet until there's something that is meaningful. And again, that's either a discovery or it is an investor. So recently, Sanu Gold got Lundin to invest, and I think it changes everything because suddenly, you have financing ability for the coming years. You have a name behind you. You have credibility. Your project has been researched by someone. It takes so many concerns away. So I mean, that's of course a little bit of a rant from my side, but and maybe going away from the topic too much. But I think it's important to consider that most stories are stories and bets and perhaps not real companies. And that's why it's so difficult to compare it to real investments.
Yes, a lot of this is just purely theoretical too. And again, just kind of shooting the brown stuff, as I said earlier. I think the conclusion on being all in on junior mining and this is, considering pure all in, like you don't own capital in your home or you own your home outright. There's no business, there's no physical metals. There's no nothing else. And so I don't even think you're 100% in junior mining. We often say that, but I believe I would assume you have some capital in your home. There's obviously a bunch of physical metals under your mattress. We all know that. We shouldn't be talking about it. But stuff like that. I mean, being 100% is probably nobody's really 100% in junior mining. But maybe if you say like my liquid net worth, whatever that means, it is 100% in junior mining. That's maybe a little bit more normal, if you say. But then it still has to kind of be your life. Like you have to enjoy going through every news release every day and all these things that you do. Like you wake up 2 a.m. to look at what's happening in Australia and sometimes place a bet and stuff like that. So there's a bit of a mindset shift where it kind of becomes being 100% liquid or 100% of your liquid net worth in junior mining becomes more of a lifestyle than an investing strategy. So if you have a normal life and a normal job and all these things, and then being 100% in junior mining still doesn't really make sense to me.
Well, and I think that's maybe even a mistake that I made trying to also play the Australian markets. You can do all the due diligence during the day. You don't have to wake up during the night. I mean, even though these things are not investments, the better ones should keep you, relaxed and sleep at night. And if you have a good Australian story, that's fine. But I think focus is fine too. And I don't think you have to really completely commit your life to this thing if you only invest in 5 or 10 names. And we will discuss that a bit later about the portfolio. Well, we should discuss it right now, I guess, but also combined with how to place those bets and how do other people place those bets. So I think focus is fine too. If you have 5 names that you're very comfortable with, I mean, to the level that you can be comfortable, you can never be completely comfortable with these illiquid juniors, depending on, non-cash flowing projects and all those things we discussed already. So you can never be completely relaxed, but you should be relaxed enough that you can leave your portfolio to it and wait and give it time. And that means buying at the right time, not in a hype, buying in a time when nobody wants that stock or nobody wants to be in that metal anyways, and having a low average in a company that you know well and give it some time in most cases. So I think that was a mistake on my end to try to be involved completely in Australian markets, completely in London markets, completely in Canadian markets, and try to be in every win. I think one win is enough to completely turn your portfolio around. So there's no point in trying to be at every party. One party is enough for your portfolio, in my opinion.
What can you hope to get in that case? And this is where we get to the second part of his comment, which is the 35% CAGR, 35% compound annual growth rate. Again, I think 25 months it could still be explained away as a fluke. I started off, when I started getting into junior mining, I did very well, but it was, what is it, the summer of, what is it? There was, I think it was the summer of 2020. And then I kind of ignored it afterwards because just everything went up. And again, it took me like 2 years or something to start realizing that I should be approaching it bottom up as opposed to top down. So I think 2 years can still kind of be explained away as a fluke, although this was not necessarily a great period in the junior market as we've discussed. So yeah, what do you make of this 35% CAGR? I mean, obviously good, but is that how you should measure it in the first place? And what can you hope to get?
Well, I think it's good to measure it, to keep yourself. I don't even know anymore. I have a bit of an idea how I performed, of course, from having not much to having a bit to protect, because I did quite well, and specifically in the high conviction names. Over the last 2 years, 3 years, I didn't do amazing. I have stocks that I have a lot of confidence in, but they didn't really pan out yet in a way of really big stock performance. And I think I took this quote with me from Howard Mark. He says, usually the market goes up. Usually it's easy to make money. The challenge is to make money at the same time you control risk. In junior mining, of course, the market, if you measure it in time, usually goes sideways or down. And at least over the last 20 years, you only had these half a year to 1 year periods when the market really as a whole went up. So in most cases, it's time to be very careful, be looking and buy at the right time, and to really profit from the market doing well. Well, in the last 15, 20 years, only in 2016 and only in 2020. But there were several years where the market was going sort of sideways. And in those years, you can still do well if you do stock picking. And stock picking is crucial, in my opinion. That's why most investment funds do not really make big returns, because they have to diversify. Sometimes even by the rules, they cannot own more than 10%. If a stock goes over 10%, you have to sell some of it. You cannot have a lot of money in cash because you are a hedge fund, so you have to even deploy your cash. But when people take money out of your fund, you have to be able to give them the money back. So it's big constraints, and it's very difficult to outperform if you have those constraints. And as a retail person, you don't have those constraints, and you could go, the moment when a company does well and even does better than you expected, you can really press the bet, as Eric Sprott is saying. He said it a few times in presentations he gave, and I think Kirkland Lake was a good example where he probably made $1 billion. And when something's working out really well, it confirms your thesis. Then of course you can buy more. And with only 5 or 10 positions, and one of those 5 or 10 that you know very well, if one of those 5 or 10 works out, why not just take more of it? So average up rather than average down only. And in those positions you can really make a lot of money. But as a fund, you have to stay below the 10% and you have to sell. You can never really make a big return. If you invest 200 million, or if you have 200 million to invest as a fund, and you can only invest 10% in one position, you're almost forced to take a high risk, meaning 5 to 7% positions to outperform. But such a fund, has to sell at 10% again. That's what you see very often. So if you find Snowline, for example, with $10 million, and you invest at 80 cents, and that 80 cents, goes to $5 right now, you make 66 million, which becomes 10% of the fund. But as a CAGR would only make 10% per year in those 3 years. So you cannot really outperform like 100% a year with a Snowline position if you are a fund that is forced to only own 5%, 8%, 10%. And if you compare that to a portfolio of, someone who manages $100,000, has 15,000 here, 12,000 there, 10,000 here, 7 stocks, a bit of cash, and Snowline, and you see the discovery at Snowline, and then you decide to put your remaining cash in Snowline and sell some of your other stocks to, of course, mitigate your risk, then suddenly you can make a 60% CAGR in the same example. But the fund cannot do it, and you as a retail person can do it. So I took a couple of these images that sort of show this, and this is not direct investment advice, but it's just sort of to show how much benefit you have as a retail investor or an individual investor, especially with a smaller portfolio, that you can make use of these stories. Because the moment a company really makes a big discovery, in most cases, especially in markets like this, you have time to still position and not pay $200 million for it, but probably pay 50 million or 30 million. So that's sort of a comparison between managing a portfolio as a fund versus managing a portfolio as an individual person.
Well, I have a couple of corrections to Howard Marks' thing here. So he says usually the market goes up. You say usually the market in junior mining goes sideways or down. I'm just going to delete the sideways. So usually the market goes down. Usually it is easy to make money. Usually it's impossible to make money for most people. That's what I would change it to. The challenge is to make money at the same time that you control risk. The challenge is to make money, period. A portfolio which has the opportunity to make money, but with the risk under control, is, in my opinion, the mark of a professional investor. I think that's actually could be a pitfall in junior mining, because we're too close to CEOs. Like, everyone in junior mining has access to junior mining CEOs. And it is their job to tell you exactly this. It is their job to tell you that there's an opportunity to make money here, and we have the risk under control. We're fully financed. We're this, that. That's the entirety of the pitch. That's essentially the entirety of their job. And again, understand the incentive of your counterparty being the CEO. That's what they have to tell you. Here's an opportunity. We know how to control risk. That's the two main things they have to tell you in a pitch. And that turns into, it's a double-edged sword. I mean, there's good and there's bad too. It's good that we have access to them so we can ask them some real questions where you don't have access to the CEO of NVIDIA the same way you would to a junior mining CEO. But also, if you're naive, like I still am, but was way more naive a couple of years ago, they are going to make you believe things that are simply not true. And so I think, to me, what really is the mark of a professional junior mining investor is someone who can make money regardless of what's happening in the market. Like, someone who doesn't know if copper is $4 or $4.20 or $4.70 today. It's just someone who knows how to make money irrespective of the market, and do it without relying on too much of a network. As in, not network in the sense that you and I have talked before, but network where you get the cheap entries. You get the very, very cheap 3 times pre-IPO round and stuff like that. So if you can, basically in the open market, let's maybe call it that. So if you can make money in the open market without paying attention to the broad markets, that's kind of the mark of a professional junior mining investor, in my opinion. What do you make of that?
Well, first of all, talking to CEOs, you don't have to take their word exactly. I mean, it is a combination between, getting a feel for the person. What type of person is it? I mean, just knowing the person's background and talk about it. What have they done in the past? And you can always verify those things and see if they were really so successful. Many CEOs claim they were part of a discovery, but then when you research it, they were probably just a student on the ground, which is fine. It's good experience, but not crucial crucial to their experience perhaps, but they were not a crucial person to that discovery. I discount a lot, and of course it's not just the positive words you get, it's the questions you can ask. It is your gut feel when you talk to a person. You can test so many things. So I don't think you have to get yourself. I don't think you have to rely on the exact words they tell you. It is a combination of things to find out: is this something I am comfortable with? Is this a person I want to speak regularly with to see how things are going? And I talk to many CEOs. Some of them I like a lot. Some of them I like, but I don't think they should be the stewards of my money. So I don't think you have to believe their words. It's a combination of what are they planning to do? Is that the type of thing you're looking for? Is that the type of risk you are looking for? Is that the type of thesis? I mean, there's so many things you can still assess for yourself. And then talking about cheap entries, I don't get many cheap entries. By knowing people, ideally you get invited to a financing almost no one else is invited to, because those are the ones that are in most cases better, but still a lot of those things fail as well. So I'm not someone who gets the best financings in the mailbox every month. So I think you can make money in the market, but understanding the hype part of things. And people indeed, like you said in your rant, look for confirmation bias. They look for things that are hot on Twitter and on other social media platforms. And mostly the things that already went up a lot, if it's for good reasons, maybe there's good reasons to still buy it. But also be very careful. This is also a hype market, and there's always uncertainty. Even in a company like Snowline, there's uncertainty. And I rather buy stocks that are going sideways, where I believe I like the people, I like the project. People are a little bit more important than project, in my opinion, because projects often fail and have to be recycled. New projects come in. And if you only came in for the project, well, then you have to leave, of course, the moment that goes wrong. So if you like the people behind it, you trust them, they have money in that company too. You can. I think the risk is already reduced, especially if you go in at a depressed time. I always like it when something went wrong, jurisdictional or with the project or anything that's wrong, but you can see a way how the company could come back. Of course, that's crucial. And the company has gone down a lot, but found sort of a sideways pattern where apparently the buyers and sellers are in balance. The moment the thing is still crashing, you never really know when it finds a bottom. And sometimes these things find a bottom and go up immediately, but in most cases, they find a bottom and it goes sideways for a long time. Then it's crucial to know how long can this company keep existing without a new financing, and if a new financing is coming, what are the thoughts of the team about it? If they don't want to tell you, well, that's sometimes a smart thing, because if they tell everyone about the next financing, it can be a bad strategy. But if you talk often enough to a company, you have to be able to find out what more or less their financing plans are, and those are often crucial to those companies who found a bottom. Well, you never know if it's a bottom, but if it seems like a bottom, it has been going sideways for 6-7 months. You like the people, you like the project, or they are looking for projects, and they tell you what they are looking for. In those cases, I think you can control risk by buying at that level, and already consider, like, what's the chance of a rollback? Are they going to do a rollback? Ask them, do they like a rollback? If they do, and they do a 1 to 10 rollback, maybe that gives you even more downside, because people don't like these things and start selling the moment the stock is 50 cents instead of 5 cents. That's just a psychological thing that happens over and over again, which is not a market cap or value related thing. So again, I think it's you can reduce risk by knowing who you're working with, and by knowing the company much better than the rest, and by having not so much competition. And in stocks that have been going up a lot or just came down a lot, there's still many people thinking about the company. The moment you are going sideways for 6-7 months, not many people are thinking about that stock anymore. And that's, I think, the moment when you can consider talking to a company and finding out, hey, is this company broken? Is this project broken? Do you have to buy something new project? Or is this project still of interest? And if you find out that there's still upside because of the project or because of the team looking for something new and nobody's looking anymore, well, obviously that could be an entry position. And of course, I oversimplify it a little bit because it takes you a lot of work and really try to understand, what if they don't find a project, and what if this project is not going to will not work anymore? The risks in the jurisdiction are too high, or whatever reason the thing came down. But the moment you find out that there's still a good opportunity for the company to get a better day again, and nobody looks at it, I think that's also, in a way, controlling risk and looking for opportunity at the same time.
You brought up a very good point early on there by saying, maybe I like the people, but I don't think they should be stewards of my money particularly. That's something I had to learn the wrong way. Not being a great judge of character, myself being naive, those are things that I've recognized in myself, trying to work on them now as it goes, still make mistakes in them, but still get it wrong. I shouldn't belittle it by calling it mistakes, just plain getting it wrong. And sometimes you can like people, but you don't want them to, steward your money. Your wife being a perfect example, not your wife in particular. I'm sure your wife's lovely. But my wife, for example, I love her. Do I want her to be a steward of my money? Maybe not necessarily. She's going to have to edit this, so I might have to come and crash on your couch for a couple of days. Now, what else do we have on here? We've really only targeted two of the things that he said. He says, I own 21 companies. At the moment, that's 6 winners, 15 losers. That's kind of he asks if this is a good split between losers and winners. I think it's pretty good. I would actually expect it to be fewer winners. What do you make of the whole thing, though? So let's talk about it. It's basically 3 parts, 21 companies. Is that too many? 6 winners. Is that normal? And 15 losers. Is that normal? Is that what you can expect? What do you make of this whole thing?
Well, 21 is difficult to say anything about that because I don't know, the size of the portfolio and the amount of time he has. It seems like a lot if you are new to it, assuming that when you're new to it, you don't have, probably not $2 or $3 million to deploy in the sector. So, and of course, you could do the same strategy with $20,000 or $10,000 versus $2 million. Why would it be different in terms of a return? I think when you have a much smaller portfolio, you typically take more risk, and typically, not always perhaps, but again, difficult to judge the numbers. 6 winners, 15 losers, also difficult to judge because if those 15 losers are on average just 10% down, well, that's just normal, right? These things go. I consider a company that I bought at, let's just say, 10 cents because I think it's cheap. It has gone down. Story that I just described, and going to 9 cents is not a problem. It's 10% down, but that's just still my average. I consider that my average, and if I think at 8 cents that I still have money to increase my position, I buy more to lower my average. But if I'm comfortable enough with that, and if I already have my position sizing, then I don't really mind the stock being at 8 cents while I paid 10 cents. So a loser depends. Is a loser like something you bought like Sendero at 40 cents and thing didn't play out and the thing goes to 5 cents? Well, in the Sendero case, the thing is going up again after the rollback, but it takes a long time to go back to your original 40 cents. That's a real loser, and it will take for sure time to get back to your 40 cents level, or perhaps you can consider it a loss. I mean, I don't want to make the decision now, but on the Sendero example, but that's a different loser than being down 10%. So I think it's difficult to judge, but having 20 companies sounds like still fairly concentrated, especially because he describes I am far from even weighted. So assuming that of those 20, 5 are bigger companies, well, that's a little bit my portfolio as well. I also have, I guess, 25. Well, if I do not consider the private ones and the ones that I got, that became sort of spin outs, probably 20, 25 positions, of which 4 or 5 are sort of the most important ones, and the next 4 or 5 are also important ones, but a little bit smaller. And then you have 10 sort of equal positions. That's so in that regard, it looks like my portfolio design in a way. But it's difficult to say good or bad. I have heard of stories of people who only invest in 5 names or 3 names. And in a way, I like it, but you have to be very, very concentrated on those things. Not just concentrate because you have 5, but also with your mind. You really have to understand what those risks are. You have to know the team very well, and I think you have to have every scenario in your mind. What could happen with all those 5, almost on a weekly basis. Rethink, like, I mean, of course, there's not news every week, but rethink your strategy every week again. Does this make sense? But anyways, I think smaller is fine too. Bigger is fine too. But I think when you go over 30 names, in my opinion, it becomes more difficult to really make an outsized portfolio return because you become too much in line with the market with ETF. Well, I shouldn't say ETFs if you have 30 juniors, but not my strategy. I would rather be below 30, but maybe that would change if your portfolio grows.
Yeah, that's all fair. I think a non-even weighted portfolio is actually kind of the only way to do it right in junior mining. Like if you've already gone through what we previously said and you've learned to what we previously talked about as well, learn to say no. You know, every company out there has a pitch for how they're going to be the next Northern Dynasty or the next Great Bear, the next whatever. But for every one of those, there's hundreds, potentially thousands of failed examples. Maybe not thousands, but definitely hundreds of failed examples. But every pitch can sound enticing when maybe you're not as experienced and you haven't had 10, 15 years of deciphering BS. And so, but at the same time, I think that the only way to do it right, if you really decide to make this at least some part of your life, and again, make it part of your life, not only make it part of your portfolio, because this is definitely not a passive investing sector where you can just go in and kind of hear a nice pitch, forget about it, and come back in 5 years and it worked out, because that's a recipe for disaster. But if you have to make educated bets that are based on strong conviction and a strong understanding of the underlying asset, the underlying management team, their financing capabilities, and so on and so forth. And you're making bets in specific companies, right? Well, in that case, then it makes sense that you should overweight the strongest positions in the first place. Of course, you have to understand what you're doing in the first place. But again, as I said, if you've gone through most of the points and if you're still sticking around after probably over half an hour at this point that we're talking, then you probably care more about the sector. So not being evenly weighted actually makes more sense to me now, thinking out loud.
Yep.
But I think depending on returns, your opinion will change. Like if I'd been down for 5 years straight, I might think like, oh, maybe I was overweight and I should have diversified more. And hindsight is always 20/20, and looking back, biases are also very, very hard to deal with. But there's many famous names that you can bring up on both sides who've done well. Eric Sprott, what does he do? 5 to 10 companies at times in size. I'm sure he's got more. What does Rick Rule say? You shouldn't own more stocks than you have hours in a month to do work on them, or something along those lines. So there's many concentrated investors. There's also survivorship bias there too. But the evenly weighted portion of it does not necessarily bug me, I suppose.
No, I think if you have 40 evenly sized positions, that's crazy. I mean, how can you think of 40 names that you're convinced of and have same conviction on each of them? So for me, it would always be something between 3 and 5 names that I have the highest conviction in for whatever reason, and positions that have a lower, and it's risk management as well, right? Ramp Metals is a good example. We have talked about them a couple of times. I talked to them at the conference I'm going to right now in Vancouver. I talked to them last year, and the financing was still open at 20 cents. I heard the story a month before that. I think I saw the presentation, and I liked it in a way because they made a comparison to a big discovery. It actually had some similarities, which is what most companies do. They compare it to a big discovery, make it, well, I shouldn't say make it look similar, because that sounds like it's not true, but they show you why they look similar and why, if they hit, it's going to be an amazing thing. And that's, of course, their job. That's fine. I have no bad thing to say about it. But I thought, okay, this is 20-cent stock. I don't even know, $5 million, $6 million, which is not a lot in a way. But if they drill this big target, or this target they have, and they drill 5, 6, 7, 8 holes in it, and nothing comes back, then this 20-cent stock is likely going to be a 10 or 5-cent stock, and you're looking at a 50 to 70% loss within months. And the stock really quickly went from 20 cents to 15 cents before the holes came out. And to their surprise and to the market surprise, they hit a big gold discovery, but they didn't hit any of the nickel they were looking for, or almost nothing. So if the gold wouldn't be there, of course, the stock would have been at 10, 5 cents. And that's why I said no to that name. But when they announced the discovery, the gold, I paid 30 cents, 35 cents, 40 cents, 45 cents in the market. So I paid, well, on average, about double the price, but with a big discovery, which is pretty good. Not paying 20 cents, including half a warrant, but paying 40 cents on average, 35 to 40 cents, I guess 40 cents, with the discovery is much better. So because it has been, it's not de-risked right now. It's just one discovery hole, and it comes with new risks at its new market cap. But there's a strategy behind it. I do play the pre-drill hole company as well, but I don't want it to be depending on one target where 5 or 10 holes can give you the outcome. Because if that's the only project you have, and you drill those 5 or 10 holes, and the market understands it's not there, then it's almost a zero, right? So I think it's important to that one can never be your highest conviction story, because it can't. No matter how amazing the target looks. If you have a company with 20 or 30 targets, and they have many layers of data, soil sampling, gravity, magnetics, perhaps a belt of rocks near other mines, a team that has done it before, a team that has, then missing on a couple of holes doesn't really matter. It will probably give you a sell off for a little bit, but maybe a 10 or 20% sell off, not a 70%. And then, of course, you have the raising capital risk, that some people cannot raise money without having a bank involved. And, there's many risks to consider. But the one that's drilling one target with 5, 6 holes to give you a yes or no can, in my opinion, never be your number 1 or number 3. So I cannot really say a whole lot about this portfolio, because we only have a number 6 winners, 15 losers, 20 companies. But it's not a bad setup as far as we can judge it right now. And the returns, speak for him, because 35% CAGR, being up 80% in 2 years is a good performance. And I think he should wonder why did these things go so well? Which companies are responsible for it, and can I learn something from it? Because there's always something to be learned from your losses and from your winners.
Part of it too, I think, is still keep on enjoying the whole work process behind it. Because if you don't, there's, on a risk reward basis, there's much better stuff to do out there in other sectors. Like, this almost just doesn't make sense unless you enjoy doing the work, and your enjoyment results in you having some kind of an edge by research. Because you are actually, because a lot of people say, oh yeah, I do research, but they don't go on Setter Plus CA and read the financial statements or the MD&A, go through the NI 43 101, talk to management, ask about the geology. Even if you're not a geologist like myself, you can get away with knowing a couple of things. But I think a couple of takeaways before we move to the stock picking contest and see what's happening there. Junior mining is it's just a speculative and highly risky sector. I don't think it's for everyone. Only those who actually want to enjoy, actually want to do the work and enjoy doing it. High risk tolerance and the ability to lose money. So be more wrong than you're right. You need expertise, you need experience, and you need to put in the time in it. There's no substitute for that. If you're just buying stock picks off of Twitter and you end up with 50 or 100 companies in there because someone talked about them on Twitter, was likely paid to do so, or has some other sort of incentive to talk about them, that's a recipe for disaster. Patience. People often say, "Oh, you need patience." Projects take years to materialize, but it has to be like targeted patience and understood patience, not just blindly, oh, my stock is down 90%, I'm going to just be patient. Maybe it does a 10x and brings me back to break even, and then it does another 10x where I get that 10,000 to 100,000 jump, and it's like that's just blind patience. I don't think that helps anyone. Risk management, sure, one part of it too, and again, just the majority of it won't work out. Market cycles can, and the geopolitics and stuff like that, they're heavily going to influence the stock performance, but relying on them to influence your portfolio positively is also doesn't look like it works over long enough time period. Like, you have to rely on your understanding of the underlying companies as opposed to so bottom up as opposed to top down, essentially. And I think that's pretty much it. What other takeaways do you have from this whole conversation so far?
Well, I wanted to mix this conversation with the CEO.ca contest
Sure.
for a reason. I try to really everything I think I say and everything I do, it really has to do with trying to make a return in this business, in the market, but typically, and it involves talking to people, very important. But I also look at lists, as you always say, and one
You're
of the
making lists
lists
as we speak, aren't you?
no. I'm looking at lists. I was looking at the CEO.ca stock picking contest list and statistics as well. I was trying to even use these statistics to get a bit of a feel for things, but that would become a very boring topic. But one thing that became very obvious to me is if you look at the top stocks that they shared, because they yesterday posted something interestingly, only has 100 views or something. They made a thread about the contest, about statistics, about the stocks that were picked by most people.
But hang on a second. What is this thing? Like, I heard about it on COCA a couple of times. I don't exactly know what's happening. I don't know what this is.
Every year on CEO.ca, people can subscribe to participate in this contest. You pick 3 stocks, not only junior mining, but it's typically junior mining or other risky things like coin-related things, or so that's the type of investments people or picks people make. You can just make 3 picks. You don't have to pay money for it, but you can win some prizes at the end of the year. And of course, it's not like an investment because people can simply take 3 risky picks and hope for success. You don't have to think about it that much in a way. But I think as a whole, it still is interesting. And these 3,000 people, a little bit more, picked 9,800 different companies for this contest. And the average of the 3 will determine who has the best performance this year.
But so wait, I just buy them? Well, or pick them or whatever?
You just mention my 3 picks for this year are A, B, and C. And that's then your portfolio for this year for the stock picking contest.
And then I don't sell, I don't trade, no matter what happens.
No, it's beginning to end. Of course, it's not completely comparable to trading, but it's interesting. And you have to have a stock of minimum 5 cents, which in a way makes sense because otherwise you can take these shells of 1 cent and hope for the best. In Australia, it's a bit weird because a lot of stocks are below 5 cents. So I'm not sure how they deal with that. But so more than 3,000 people, entered their picks, and it was interesting because CEO.ca shared some names and statistics, and it's obvious that the top 10, top 20, is very popular for some reason. I mean, most names I never looked at myself. But if you then look at them individually by the chart, the top 5, all 5 of them, already had an amazing run behind them. Some of stocks went even from a couple of cents to dollar plus type thing, and companies like Magna Mining, really good companies, but also being up 4 times in a year, are being picked, and not suggesting that those things cannot continue because often companies that did well for a reason and can continue, but sometimes these things are hypes too. And there's a couple of these quantum e-motion things. I don't know anything about it, but it looks to me as a short-term thing by the chart. And these things are the most popular ones, which in itself is already an interesting fact to determine, I think.
I'm just kind of looking at it right now. That's the setup for the contest is I don't get, I mean, especially in the context of venture capital, non-revenue generating companies that like in a real world scenario, you could constantly buy and sell based on news and results and management changes, market sentiment, whatever else that we just discussed. But not being able to adjust your portfolio throughout the entire year is I mean, that doesn't really seem too realistic to me. I know, or maybe even, take some profits, do risk management, position sizing, man. There's just so many other things going on. So I'm not sure what this really represents. Like the statistics and everything on here is done well. Um, it's visually enticing and everything. Just not really sure what it communicates. They also say where the smart money is flowing, 58% is metals and mining. Smart money, I don't even know what that means in this
No,
case.
it's a gimmick. Of course, they don't take. I mean, if you look at their advertisement, it's of course it's not very serious. It's like a play, it's something
Hmm.
fun for the year, and you can, people enjoy doing it, and it's not. You shouldn't make it bigger than it is. But what I like about it is, um, not, I mean, picking something on the first day of the year and hoping for it to be the best thing exactly January 1st next year. Of course, you have no control anymore during that year. From that point of view, it's not too interesting from a perspective of learning from it. But if you look at the companies people pick, is a bit of a confirmation that people go for stocks that either already went up a lot, but everybody talks about it because that's typically not the way you want to invest, especially if the stock already went up for 6, 7, 8 months. Well, again, unless you did all the work and you determined that this is the best new discovery and you still can buy in. I mean, it's not always wrong, but
Hmm.
it was very clear to me that all those the first five were really big winners, and people want to be there with their picks. But then you look at the next 10, and you also see companies that did very well last year, but then crashed, and are still in this sort of crashing mode, in my opinion, and they want to pick this one because they probably think it's cheap, which again is not something that's necessarily wrong, but in my opinion, often riskier, because companies can go down a lot, and sometimes you feel like you have a bargain at 50 cents, but then a week later it's 25 cents. So people are where the volatility is, where the talk is. It's either going up very quickly or down very quickly, and that's of course the topic that's being popular right now because everybody talks about those stocks that are moving up or down, and that's where people place their bets. If I look at the companies that I own in my portfolio, I looked at 10 important ones. Most of them are picked 0, 1 or 2 times, and
Hmm.
only 2 of them have been picked 12 or 14 times. So I'm not. I mean, again, I'm talking like I am the one who knows how it all works. I have my own way of doing it. But I like it because my strategy is not to be where everybody already is, but where everybody's going to go this year or next year. And the number of times my stocks were picked in the contest by 3,000 people is encouraging because nobody picks them.
Mm-hmm. That's a good way of looking at it. Maybe I was just raining on the parade a little bit. You fair to say it's a gimmick. It's kind of meant to be fun as opposed to educational or whatever. But yeah, I can see where you're coming from with this. I mean, it's the whole thing that I said at the beginning. Like if I see a stock that's being heavily advertised, which a lot of these companies, I'm looking through the list as well. A lot of these companies are heavily advertised in one way or another. Some of the advertisements is that happened um, are just based on the stock price move essentially. So they, because the stock went up, that's kind of an advertisement in and of itself. Everybody's looking at it.
That's the
Um,
best thing. That's the best thing to attract people. A stock that's going up.
yeah. So it seems. So it seems. So I know you have to run now. You wanted to close it. Is there anything else you wanted to add on the? Again, I haven't followed this. I don't quite understand it yet, so I don't really have anything intelligent to say. Not that I typically do, but I might try a few times. What else?
No, no. I think this was just an interesting. I like the statistics. Not many people have looked at it on Twitter yet, and I like it because it gives you a bit of a, you know, it gives you a way to look in people's minds what are people looking at? Most names I have never seen or don't really know very well is apparently where most people are right now with their thoughts, and that's what I like about it. Of course, it would be fun to have something like this as a game where you can buy and sell and compete with people. I think it's important also to realize that you are actually competing in the market with other investors, and getting in is not often easy because there's not a lot of stock available. But getting out is also not necessarily easy because again, unless of course a company has some groundbreaking news and you can sell on liquidity. So in trying to outcompete people, going where there's only 10 people looking is way easier, of course, than going where 500 people are looking or 1,000 people or more are looking. And so just realize when you go to one of those popular stocks, you at least have 100 times the competition in terms of research compared to the stocks that are going sideways and nobody's looking at it. You are probably one of the few looking at it right now, and that's why you don't have that much competition.
Well, let it be known, it is January 15th that you came up with the idea of making this into an actual game and an app, because I'm sure someone will develop it sooner or later, specifically for junior mining, but it's your idea and they have to pay your royalties. Go to Vancouver, enjoy, let me know how that turns out, and hopefully speak soon.
All right, thank you.